Hi everyone, welcome back to class. In our last class, we saw how we can use the various case scenarios to project our financial forecasts. Today, we are going to continue from where we stopped. We've been able to populate our life case scenario. We've been able to populate our life case scenario using the choose function. So I'm going to change the color of this, right? I'm going to change the color. Now, in financial modeling, there are different colors that are used in financial modeling. So we basically use the color blue for hard-coded input. Then we use black or gray for formulas and green for internal links. All right, so I'm going to change these colors that we have here to black or gray. All right, so I'm going to just change them to black since they contain formulas. I'll just change them to this. So what we are going to do is just go straight to our income statement. We want to start populating those figures. All right, so what we are going to do is this is our revenue assumption. Look at our revenue here. So most times if you are preparing a financial model, you are supposed to be as exact as possible. You can get the price, the quantity, all those drivers for revenue, the capacity and the rest. But if you don't have, in this case, we are doing a projection, right? So we are just going to work with all those growth, percentage, and the rest of them, right? So for our revenue, let's see our life case. This is our revenue row, right? It says that for this base case, you can see our base case here. We are on base case. If we change it to best case, you can see it changes to 8% revenue growth. Worst case, 4% revenue growth. So I'm going to keep it at base case. Let's see. We say at base case, our revenue will be growing at 5%. So let's go and implement it. All right, so we are going to come here and say, now, do you remember how to grow your revenue? And you unmute and let me know how we are going to grow our revenue. Tell me quickly.
How we're going to grow the revenue or the formula for revenue?
Growth, yeah,
Which one?
go ahead. Formula for revenue growth. We want to grow our revenue. We've been given from our assumption, we said that our revenue will be growing by 5% each year, right? You can see.
Mm.
So how are we going to apply that here?
So the each revenue times 5%.
The year revenue of the previous year, right? Times you open your
Yes.
brackets,
Five
one plus the
plus
percentage. So you just go up and select that percentage here. Do you understand? You close your
mm.
brackets, then you enter and see our revenue is growing towards 150,772. The previous year, this year is 158,311. So we are going to go to our cost of sales. What is the assumption for cost of sale under that live assumption? You can see our cost of goods sold is a percentage of revenue. And in this case, it's going to be in year forecasted year 2017 is going to be 37% of our revenue. Did you get that? So what are we going to do with the information? Let me hear it from you, Onyi. Are you there?
Yes, I'm there.
Yeah, go ahead. Let me hear you. How are we going to implement that? Why is it taking you time, Onyi?
I'm thinking about it.
Okay, so we said cost of sales is going to be 37% of revenue. How do you implement that? You just say,
Yeah, it's going to be um 37% of our revenue.
mm-hmm.
That's 0.37 times our revenue.
Yeah, you can just go there, right? Pick that percentage, then you multiply it by our revenue figure here. The revenue we've gotten here, right? You enter, that is your 37% of revenue. Do you understand that? Yeah, so our gross profit is just revenue minus cost of goods sold. Is that correct? So just enter. Then we go to our salaries and benefits under expenses. So now let's look at our assumptions under salaries and benefits. Salaries and benefits, there are two assumptions we have here. We can say salaries and benefits can remain constant through the year, right? But that doesn't seem so realistic, right? So for me, I would choose this one, salary and benefits year on year increments. It's saying it should increase 10% per year, right? So it can be because of the inflation or economic um whatever, maybe cost of living allowance or maybe increment in the number of staff, or want to just increase salaries and benefits by 10% year on year. So what we are going to do is, okay, will you tell me, Faith, how are we going to implement that now?
Um, that should be the previous year times the 10%.
Previous year times 10%, that's not going to work. Do you think it will work? You increment it
Okay,
times,
one,
oh,
okay,
yeah,
one
one
plus.
plus that percentage, right?
Mm.
Yeah, that's how you're going to do it. So this works. You can see it's increasing by 10% year on year. So rent and overhead, how are we going to implement it? Let's look at our assumption. Rent and overhead. Do we have an assumption for that? Yeah, we do. Can see. So this one looks reasonable because, of course, rent can remain reasonably constant for a while, maybe for a few number of years. Some landlords can keep their rents constant for about 5 years. Is that okay? So we will just link it to that assumption there. No calculation. Can you see that? Is that okay? So basically, our total expenses is just you adding up this, right? Adding up your salaries and benefits, then and overheads. Okay. Right. So EBITDA, how do you get your EBITDA? Let me ask you. EBITDA, earnings before interest, taxation, depreciation, and amortization is your gross profits minus your administrative expenses, right? All these expenses. So we choose this total expense. Enter. The next thing is depreciation and amortization. Let's go to our assumption. What is it saying about depreciation? Saying depreciation and amortization is 40% of property, plant, and equipment opening balance. Now, remember when we were talking about our drivers, for you to get your depreciation, you need to calculate, you need to know the fixed assets for the year, maybe the opening balance, maybe the one you are going to buy for the year, right? So there is a schedule down here. We're going to work with this schedule and we're going to complete the schedule. Look at this. We have some schedules here, supporting schedules. We have working capital schedule that contains all the working capital. Those are our current asset and current liabilities. Then we have depreciation schedule. Depreciation schedule is also same thing as PPE schedule, right? PPE schedule. Why? Because it is from this schedule contains both our property, plant, and equipment opening balance, the capital expenditure with less depreciation. So let's look at it here. This is our line for depreciation calculation, right? While I'm calculating this or while I'm going through this, you can call my attention if you do not get any part of it. So what we are going to do is we are told in our assumption that depreciation is 40% of our PPE opening balance. Now, what is our PPE opening balance? PPE opening balance is the closing balance of the previous year. So we are going to say this is our opening balance. Is that correct? Then we multiply it by, hold on, please. Oh, God. Height. Okay, so we have our PPE opening balance as the figure for the previous year's closing balance, right? Then we go to our assumption and select that 40%. So this is our assumption up here. That's the 40%. So let's complete this schedule. What is our PPE opening balance? Our PPE opening balance is the figure for the closing balance of the previous year. What is our capital expenditure? That's the amount we are using to buy property, plant, and equipment or fixed assets for that particular year. It's always given by the management. We want to decide how much, we want to spend in property, plant, and equipment, capital expenditure. So let's go here. You can see this line item here, capital expenditure for the year. So for this 2017, it is 15,000. So let's select it and press enter. So we have our PPE schedule. What is the closing balance? The closing balance is equals to the opening balance of PPE plus the capital expenditure minus the depreciation. You enter, and this is what you have. So we select all this, drag to the right, and press Ctrl R. So this is our PPE. So let's go back to our income statement where we'll impute our depreciation. If at any point you can't hear me, let me know. So we have our salaries and wages, we have our depreciation here. So let's go and link it to our computation down there. Let's go to our schedule and link it there. This is our depreciation figure for the year, right? So the next thing to do is, this is our EBIT. Our EBIT is simply your EBITDA minus depreciation. EBIT stands for earnings before interest and tax. So what is our interest? Can you see this line item here? Let's go. We need to prepare a schedule for it. Let's go to our supporting schedule, interest. Now look at our debt. So you pay interest when you take debts, right? When you take loans. So this is our debt schedule here. This is our debt schedule. What is our opening balance of debts? The opening balance is the figure for the closing balance of the previous year. Then what is our issuance or repayment? If in a year you are taking more debts, that is issuance, debt issuance. if you are paying back what you're owing, that is repayment. So let's go. Let's know our assumption. Let's see. From our assumption up here mm, on the life case scenario, remember that when you are working with your financial statements, you work with the life case scenario after you've made all your assumptions. So let's see what is our debt repayment or issuance. Can you see? Can you see this? So let's go to 2017 and select this and we enter. So there's no debt issuance or repayment for that particular year. So what is our closing balance? Our closing balance is basically the opening. Okay, because this can be the issuance or repayment can be a minus or a plus. So we just do an auto sum there. So for this, sorry, I'm struggling with my zoom control button here. Sorry. So what we are going to do is, guy, stop disturbing me. So I'm just going to say sum of this, and this. Now the interest, what is the interest on this? The interest is equals to, let's see, what is the assumption up here? Our interest percentage of debt opening balance. So we're going to say this, that's 3% times the debt opening balance. This is the opening balance, right? Debt opening balance, enter. Now, most times you can use an average of the opening and closing balance, right? So you can just say, it is the average in order to give room to changes that might be occurring within the year. This is opening and this is closing balance, right? But I can just say the balance of the previous year is the opening balance, and the balance of this current year is the closing balance, right? You can close and enter, right? Sorry, we didn't apply our percentage times the percentage in the assumption, right? So on real case, in life cases or real cases, you have different debts that the company has taken, and each of them come with their percentages of interest payment. So that's why you are going to prepare different debt schedules. But because this is a simple forecast, we're going to just make do with one debt schedule. I hope that makes sense. So since we have our debt schedule here, we're going to select everything and drag right and press Ctrl R. Yes. So look at this debt schedule. When we go to best case, you see there are different assumptions for them. So let's go back to our base case. So since we already have our interest expense, let's go back to our income statement and link it equals to, go to your debt schedule and link it. This is our interest. Yeah, so we have our interest expense. Now, the next thing is earnings before tax. Of course, it's equals to the earnings before interest and tax minus the interest payments. So we have that taxes. How do we get our taxes? Let's remove that and go through it again. Now, let's look for our assumptions for taxes. What is the assumption for taxes? This is our tax assumption. Our tax assumption is percentage of earnings before taxes. That's EBT, 28%. So that's 28% times our EBT. EBT, this is our EBT, right? So we have that. So you can see we have, for this particular year, we've completed our forecast, right? So we can just go ahead and select everything, drag to the right, and press Ctrl R. And you can see we've completed our income statement forecast. Now, before we go to our balance sheet, let me know if you have any question as regards this. Now, while I'm waiting for
Did
you,
you need to
okay, I'm
did
listening.
you need to put absolute reference?
No, I didn't need to do that because I
Okay.
wasn't going to fix anything. Right. It's just row movement, row wise movement. So
Mm,
yeah, I
okay.
wasn't dragging anything down, right? Just
Okay. Okay.
yeah. So if you want to try test it, you can just press your F2 and see what you're doing. Right. So we have our revenue times the cost of sale assumption here. So these figures here you can see here, or these diagrams here, these are called spark line. Right. So how do you insert it? You can just go to, let's see, how do we insert spark line? You can go to, let me see again, how do we insert that? Let me see. Okay, so you go to insert, then you see spark line. You can use a line, right? Data range. The data range, you select the data range. So I'm going to delete that and just do this. Right, let me delete this. Oh, okay, let me override it then. So I'm going to override this Control C, Control V. Right, so that's the easiest way to override something. Just copy from an empty cell, then paste it there. So I'm going to just insert this spark line. So I go to my inserts tab, then you can see this spark line section here. Then what you do is select line, then you see what is your data range. I'm going to select all this data range. All right, let me just select everything here. Then, okay. So I've done that, right? Another thing I can do is say sparkline color. I don't need to change the color. Marker color. I want to mark the high points with red and mark the low points also with red. The low points, I also want to mark it maybe with another color entirely. That's fine, you can see. So that's how it just tells you, it just shows you the movements at a glance, the movement of your line items. It just tells you, okay, revenue is growing. All right, so let's go to balance sheets. What about you? Do you have question, Win?
No, I don't.
So you are very sure.
Yes, yes, I do.
Okay, so let me see. Okay, so I'm going to the balance sheet side of life. So our balance sheet, let's see, we have our cash. Okay, so our cash comes from the cash on our balance sheet, of course, is linked to our cash flow statement. You can see this is now how your your balance sheet is linked to your cash flow statement. So we'll go to the figure, the closing cash balance here. You link it, right? So it's not going to show anything now because we've not worked on our balance on our cash flow. So it's going to be empty for now. But when we work on our cash flow, it's going to populate the cash balance for the year, right? So look at our accounts receivable, inventory. No, all these are assets. In a bigger balance sheet, your cash, account receivable, are going to be under current assets. Is that okay? Then your property, plant, and equipment, of course, and other long-term investments are going to be under non-current assets. I'm sure you know that, right? So look at this cash. We've linked it to our cash flow statement. This account receivable and inventory are under our working capital, as well as accounts payable that is under liability. So what we are going to do is we'll go to our working capital schedule. You can see the schedule down here, this supporting schedule, working capital. So we are going to go over how to do our working capital schedule and then go ahead and link it to our balance sheet as well as our cash flow statement. So I'm going to see, let's see, escape. Okay. Okay, that's fine. That's fine. Okay, I wanted to see if we still have more time. So let's go to our working capital schedule. Now look at this. These are our historical figures in our working capital schedule. Historical figures. Yeah. So one thing to do is our account receivable. Account receivable. What is the assumption? If you're not giving an assumption, there is a way you can work around it with the figures you have. But then let's see, do you have assumptions? Inventory days, account receivable days, the number of days it take you um collect collect your money from your debtors or from your account receivables, right? Then inventory days, the number of days it takes for you to for your inventory to stay in your store before you sell them out, right? Then the accounts payable days, number of days it takes you to settle your creditors or those you are owing in the course of your operations, right? So the thing is, of course, you should ensure you sell out your inventory as quickly as possible. Hold on, please. Okay, so you have your accounts payable days, right? So we are going to use this number of days and use it to populate our working capital schedule, right? Let me see how many more minutes we have. Okay, so look here, because we want to convert those number of days to amounts, right? What we are going to do is we're going to say those number of days divided by the number of days in the year times either cost of sales or revenue, depending on which line item we are talking about, right? So we're going to, of course, we will need these days in the year. So I'm going to show us how I got this number of days in the year. And yeah, okay, let me delete this line item. So follow me. We have this equals to dates. So the first parameter is the year. What is the year? 2017, right? Months. So I'm going to say the last day of the year minus the first day of the year, right? And see what it gives us. The last day of that year is 31st. Right, sorry, the month is 12, right? 12. Then the last day is 31. Then I'm going to say minus this same formula again. Then I have the year, this year, right? Then the first day of the month. And so we have 364. I'm going to add 1 because it didn't count the first day, right? So once I'm done with this, I select to the right and drag to the right. So you can see this 2020 is a leap year. It has 366, right? So we are going to implement this to our working capital schedule. So let's go back to our working capital schedule. What we are going to do is to go back to our schedule down here. All right, we have our working capital schedules. So you see our account receivable. So we have account receivable days in our assumption. So let's go back to our live assumption. What's our account receivable days? Account receivable days divided by the number of days in the year. So I'm going to fix that. I'm going to fix this. I'm going to lock it down. Right. So I'm going to lock that row. Sorry. Let's lock the row here. Then now account receivable days. If you want to get account receivable, what are the drivers? Account receivable is an element of sales, right? You need to make sales before people can owe you. Is that correct? So let's choose our sales for that particular year. So I'm also going to log the row. Is that okay? So this is our account receivable for that year. Let's see. Inventory. So I would have actually, okay, let's see how I'm going to now repeat that process. Let me see. Let me copy this. Control C, Control V. Now let me do F2. So I want it to go to my inventory, right? My inventory assumption. Let me know if you are, this is my inventory. Oh God. Sorry, I actually use inventory for account receivable. Okay, that's correct. Sorry. That's my inventory assumption. You can see this is my inventory. So that formula is correct. The formula is correct. Is it correct? Is it correct? Inventory. Let's go over it again. Inventory is as a result of inventory is part of cost of goods sold, right? So it's not going to be on sales, it's going to be on cost of goods sold. So we are moving this to this. Did you get that? So what you're going to do, let me not confuse you. Let me just go over it again. Equals to, but it's very good as a financial modeler to use formulas that you can always copy and that you can actually reuse. Do you understand? So our inventory, to get the inventory figure, you're going to say inventory days. You're going to use inventory days, right, over. This is my inventory days divided by the number of days in that year times cost of sales, right? So I'm going to my income statement and use cost of goods sold. That's my inventory. That's actually so little. Is that correct? Let me see. Okay, that's fine. As long as we know what we're doing. So for accounts payable is account payable days from my assumption. What is my account payable? Go to 2017 divided by number of days in that year multiplied by account payable. Account payable is from cost of sales, right? Cost of goods sold, because when you purchase, you might purchase some of your items on credit, so you need to pay your creditors. Account payable, right? So your net working capital. Can someone tell me how we arrive at our net working capital? Our net working capital. Accountants in the house. Unmute, please. I'm waiting. Oyin, tell me, how do you get your account paid net working capital? Faith.
It's our,
Okay, I'm
it's our
listening.
current assets minus our
Current assets. So you're going to pick all your current assets items here, right? Which includes your account receivable plus your inventory minus your accounts payable, right? So you just then what is your change in net working capital? Change in net working capital, right? It's basically that of the previous year minus the current year. Is that correct? Let me know if it's correct. If it's not correct, call my attention. So you drag to
previous.
the right. Do you say this is correct? Did you say this is correct? Now look at this. This goes to your
Current,
sheet. I'm listening. You say it should be current year minus previous
I said
year.
yes.
Why did you say so?
I don't know. I think that's how it's been
Faith,
done.
Faith, why should it be like this?
I think, we are talking of the change in net working capital, right?
Yes, yes, change in net working capital
Because it's change. It's the difference between the 2 years.
in the current and the previous year. So how do you determine if
Mm.
you're going to say current year minus previous year or previous year minus current year? How do you determine that? Okay, let's
I
continue.
don't
Why
know.
you think about that? Right, so we'll just link our accounts receivable, right? You go to say this, then go to our working capital schedule to link our account receivable. Now, because we've linked that, we can just Control D to duplicate that, right? It just links to our account, our inventory, because we know that inventory is the next line item there, right? So property and equipment, we have already prepared our PPE schedule. So let's go and link it. So one thing about balance sheet is a balance sheet is just a list of our balances. It's just telling us the present state of our assets and liabilities, right? So this is our closing balance. Balance sheet is just list of closing balances arranged in assets and liabilities, right? So we just select our PP closing balance, right? You can see. So basically this is just an auto sum, right? Or it equals to. Now because we've gotten this, okay, let's continue. Accounts payable, we already have our accounts payable in our working capital schedule, right? Accounts payable, just link it and press enter. Now, what is our debts? We already have our debt schedule prepared. So you see, once we prepare your schedule, life becomes easier for you in preparing your balance sheets. So this is our debt schedule. I just link it. The closing balance always goes to your balance sheet, right? So you just do your alt equals to for this and your goods. Our equity capital. Yeah. So let's see from our assumption, what do we have? Is there any equity contribution, equity issuance, or repayment? You can see there is none, but we just link it to the assumption. All right. What is our retained earnings? Our retained earnings is basically the retained earnings for the previous year. Then you add your profit after tax. Is that correct? Since we are not paying any dividends. So if it's a full schedule, if it's a full financial model, you can prepare a schedule for your retained earning, right? In this case, there is no um there's no payment of dividends, right? So we have our shareholders' equity, right? Just add up your equity capital and your retained earnings. Then your total liabilities and shareholders' equity is just the addition of your shareholders' equity and your total liabilities, right? So you can see when we check, you always use checks in your financial model so you can see if your balance sheet is okay, if something is sticking out. You also use checks in your cash flow, right? The checks for your cash flow is when you compare your cash balance in your cash flow and the one in the balance sheet, right? So you can see our balance sheet is still sticking out basically because our cash has not entered in, right? So let's just give it time and continue. Hopefully it should balance. Now, another way you can see here, we've put those checks up here, your balance sheet check and your cash flow check. So it just helps you to, see at a glance if your model is making sense, if you're balancing or something is still sticking out. Right, but sometimes your model might balance, but it might not still make sense because of the assumptions, or maybe you have some issues in your linkages. That's why it's very good to be calm when you're building your model. Like, make sure that you're not linking the wrong cells and your referencing is also good. So let's see, profit after tax. We want to work on our cash flow statement right now. So one thing about your cash flow statement is you can link it, can start with your profit after tax. Most financial models want to start from the profit after tax. Some people start from the profits before tax. Then they still need to, still include a line item that has their taxes. But to make it easier for you, can just link to your profit after tax. So you can see this is the relationship between your cash flow statement and your income statement, right? So let's link to our income statement. That's okay. So you add back your depreciation figure. You can go to either your depreciation figure on your income statement, or just go to the PPE schedule, right? And use the depreciation figure there, right? Another thing is you can less your changes in working capital. So let's go to our changes in working capital. This is cash flow, right? So our working capital schedule is down here. This is our changes in net working capital here. So let's pick it up. This, right? So cash flow from operation. These are your cash flow from your operating activities. You add up all this to get this. Then let's see, cash flow from investing activities basically is when you spend money, when your company spends money to acquire fixed assets like property, plant, and equipment. Right, so let's see, what is our CapEx, our capital expenditure for that year. You can see it from our schedule here. You can see we spent this amount, right? This amount for purchasing capital expenditure on capital expenditure, right? So basically, since it's cash flow statements try to look at all the cash that is coming out and the ones going out. So because this is an expenditure, we put minus in front of it, right? To show that the cash is going out. So let's go to the next line item. We have Of course, there can be other cash, investing activities, right? But that's the most common of them. And this is a simple financial projection. So let's go to the next, which is financing cash flow. Has to do with the financing of the business, the capital inflow, the outflow, issuance of debts, right? So let's see, has there been any debt issuance or repayments? We have a debt schedule. Let's just link it to it, right? We have a debt schedule here. Issuance or repayments comes here. What else? Issuance or repayment of equity. Sorry about this. Equity. So let's see. Let's go to our assumptions. That's where we'll find that. Has there been any issuance or repayment of equity? Equity issued. That's when you can issue more more shares, or you can do share buyback. Do you understand? So when you do a share buyback, you are basically taking shares back from the holders and you give them money in exchange for that. That's like a repayment. So we just link it to this and we do auto sum and that's it. So we are going to just go to the last part of it, which is net increase or decrease in cash, which is the addition of all the different types of cash flow, which is cash flow from operating activities plus cash flow from investing activities plus cash flow from financing activities. You add up. Now you add the opening cash balance, which is the cash balance of the previous year. Then this is just an addition of the opening plus closing balance, the net increase or decrease in cash plus the opening balance to make up the closing balance, right? So since we've gotten all this, now let's see. We are going to drag everything. Oh, okay. Something is still sticking out, but we are coming back to that. Right, so let's do this. We're just going to drag all this to the right. We select and drag and press Ctrl R. Things are sticking out. Let's see what is sticking out from our balance sheet. First of all, now let's see. Let's go to our cash flow. Oh, sorry, our equity here. So look at, can you see? Let me know if you can still hear me. Now, this is our equity capital. Since it's a balance sheet item, right? Our equity is the equity of the previous year plus any other injection of equity capital, right? Let's see, is there any other injection, any other issuance or repayments, right? Just link it to this. Then we drag to the right, Control R. Okay, something is not working yet. Let me see. Okay, okay. What about our retained earnings? Oh, we've not dragged this, sorry. Control R. What is still going on here? Hmm. Oh, sorry. We've not even dragged our balance sheet at all. Sorry. Oh, God. Okay, I thought we were done with this balance sheet. Okay, so we can say our balance sheet is now okay. So our balance sheet is okay and our cash flow is okay. Can you see that? Now, I want to know if you have any question. Let's discuss this before we go ahead and work on our dashboard to do a summary of everything we've done so far, right? Let me know if you have a question.
Okay, the question I want to ask is this spark lines I could
This
remember
was
that the spark lines,
okay. I'm listening.
I remember that we actually did them on the income statement. So is it automated as well?
No, you can do them. You can do them.
Oh,
Just do it on
okay,
your cash
sure.
flow. So I'm going to just work on all of them, right? So I'm going to just remove the ones I've done, right? Control V and just insert. So I'm just going to my insert, right? Insert ribbon, go to Spark Line tab, select line, then data range. I just go to my cash flow, right? I just select from all this. You can just select all this and press OK. Nice. So, so I can just put the color. I want to mark all the high points with maybe green and the low points with red. You can see. Is that okay? So you can see our depreciation here from this spark line shows that our depreciation is continuously decreasing, but there was a spike in a certain year. You can just play around with the spark line. It just gives you an overview of how your data is behaving, right? But we're going to still do a dashboard to really understand, like give a summary of our financial, the important aspect of our whole financial statement here, right? So I think we can call it a day, then continue our class in our next session. But I'm still open to more questions. If you have any question, let me know before our time elapses. Or should I ask you questions? Okay, so what I'm going to do is I'm going to send you this file. You're going to work on it, then also build a dashboard so that we can now build a dashboard together in class. Is that okay?